But judging by the performance of the equity market in the second half of last year and the beginning of this one, investors may be forgiven for thinking that all risk had evaporated, while sentiment and company valuations have changed for the positive. Some question whether the good news has been overdone. Joining us from Cape Town for the full show tonight is Claude van Cuyck, Portfolio Manager at Some Unconstrained Capital Partners. Before we go to Claude, a quick update from Warren's side.
Yes, that's right, Bronwyn. We obviously talk about this risk that's evaporated, and there are some concerns still there. This is some graphics courtesy of Alan Gray, and it's the Schiller PE ratio. You can see over here, this is what this ratio does is it takes the last 10 years earnings per share of the S&P 500 index and adjusts it for inflation. And then it takes the average, and as you can see just on the far right-hand side there, we're still above the long-term average of that ratio, which implies that the risk market valuations have kind of run ahead of their long-term average. So just a word to be cautious. If we look to the next graph, which is the one of the all-share index, you'll find a similar story. The Schiller index has actually moved across. This is the S&P 500 index inflation-adjusted earnings per share. And that's relative from its start in 1890, and you can see how it's moved up over the course of about 120 years. And just to now bring it into the local context, if we look at the next graph, you'll see that the risks still abound in our local market, because if we do the Schiller PE ratio on the all-share index, you can see we are above, again, the long-term average. So what it means is that the valuations of companies have moved up largely on the back of higher ratings. And that's the reason why we're seeing some concern from investment managers around where the markets are at the moment. So I think the first thing, Bronwyn, we want to do is ask Claude, does he see a difference in the local and foreign markets in terms of valuations, and are those earnings going to come through?
Well, Mr. van Cuyck, the stage is yours. Do you see, and what is the difference right now between local and offshore valuations?
Sure. Hi, Bronwyn and Warren. I think from a valuation point of view, one's got to separate a few issues. Firstly, if we look at the international markets, generally we do see quite a bit more value in some of the developed economies of the world. So as you know, there, from a valuation point of view in Europe, we've certainly seen quite a few opportunities. In the US, very selectively. And if we look pretty much at the South African market, it's also, we have to split that from a sector point of view, because at the aggregate level, valuations are clearly ratings. The market has re-rated fairly significantly, but it's still not at record levels. So it's not at levels that are unsustainably high. If you look at the historical PE multiples of, let's say, 15, 16 times for the market, it's closer to the average that we've seen since South Africa opened up to the rest of the world in 1994. Obviously, it is a bit higher if you go back to the 1960s, where the average multiple was around about 13 times. But again, one's got to break that out from a sector point of view. And where we do see the market being particularly expensive in South Africa is more so within the industrial index. So industrial PE ratios are at all-time highs, sort of 3 standard deviations above their long-term mean at about 20 times PE multiples. But then you compare that to, let's say, the financial index and the resources sector, where we see a better relative value in resources and to a certain extent within financials. So you need to actually dig down, and from there, there's still some good, decent value opportunities if you look at it from a stock picking point of view.
Claude, I think before we get into some of the specific sectors that you've mentioned there, obviously this is quite a normal thing as the markets run ahead. The valuations push up in anticipation of earnings growth. I just wanted to see and get your sense of what you're expecting, just very broadly, from earnings growth in the States and in Western Europe, and contrast that against our local market in terms of what you see for the next year or two from the earnings side.
Sure. Okay, from an earnings growth perspective, I think we should be fairly modest in our expectations, and that's both if we look at the South African market and we look at the globe. I mean, clearly we understand that there are a lot of issues, certainly in Western Europe and in the European market. So, if you're looking at earnings growth fairly flat to 10%, I think that is probably more realistic, and I'm talking very much now at the aggregate level. And it's probably not too dissimilar in the South African context either. the South African earnings base is a lot higher than it was certainly 2, 3, 4 years ago, where return on equity and margins have improved dramatically. So again, we're not really anticipating fantastic earnings growth. I think if you're looking within the financial index or the financial sector and banks in particular, you'll probably see decent 10 to 15% earnings growth out of that segment of the market as the bad debts sort of roll over and return on equity improves. Industrials are off a very high base now. We think maybe at the aggregate level, again, single-digit growth is probably likely.
Claude, let's pause there. Let's pause there.
Let's pause. Commodity prices.
Let's pause on the industrials before we go to the resources and just look at valuations in that space, specifically pulling in the retailers relative to other industrials. I'm thinking, taking into account previous conversations that we've had, that you may have pulled out of retailers some way back, or have I got this wrong?
No, that's correct, Bronwyn. I mean, we, as you know, are value investors, and if you look at the retail sector, valuations are at extremely high levels. So, I mean, paying 20 to 30 times P multiples for some of the clothing retailers and some of the food retailers, that's excessively expensive. I think the probability of generating decent returns for investors is very low if you're paying those types of multiples. So we don't see any value there, and being value managers, maybe you exit that sector a little bit earlier than some other investors, but we don't have any exposure outside of one or two of the furniture retailers, where they're trading on very low single-digit PE multiples. But that's a segment of the market that is particularly expensive.
Claude, I'm just interested to get some historical perspective here. And you mentioned earlier, valuations are not stretched. They are a little bit high, but they're not stretched on a historic basis by any wild swing. With regards to the retailers, has it surprised you how far the valuations have run?
Warren, yes, in many respects, because this is what happens clearly in markets. You get to a stage where obviously there's been fantastic earnings growth. There have been a lot of factors that have worked in the retailers' favor over the last few years, and that has driven a fair amount of euphoria. And we know the behavioral factors of the markets, this issue of fear and greed. And greed is definitely coming into this segment of the market where people are willing to pay up for the significant earnings growth. The problem is, the market implied price to earnings multiples, they're expecting earnings growth in excess of 20% compound for the next number of years in order to support these types of ratings. And, the risk is definitely on the downside there. And the probability of this base that the retailers can sustain this type of growth, we think is very, very low. So ultimately, people that are invested in that segment of the market, as good a companies as these generally are, the probability of big disappointment in terms of performance over time, I think, has increased dramatically.
I brought you to industrials to focus on that, and you're about to start mentioning the resource view that you've got at the moment, and potentially there you've uncovered some value. I know Anglo American's a big play for you and has been for some time.
That's correct. I mean, if we go back historically now, we don't necessarily think in 1 or 2 year sort of cycles. But if we go back clearly in 2007, 2008, the resource counters were excessively overvalued at that point in the cycle, where commodity prices were high, and the world was expecting this phenomenal growth from China to continue into perpetuity. And at that point in time, we had very little exposure to resources, if any, and a little bit to precious metals, and we had zero exposure to Anglo American. But clearly in this ensuing period from 2008 to 2009, we saw big corrections. We saw share prices of Anglo American going from 550 Rand down to 124 Rand. And through that period, we started to see a lot better long-term value coming out of the likes of Anglo American. So over the last 2 to 3 year period, we have built a fairly reasonable position in Anglo. Clearly, in the short term, I think there are a number of challenges. We've seen within the business the write-down of assets, in particular in the iron ore assets in Minas Rio. There's also been a lot of negative news around the platinum sector, a lot of negative news around the restructuring of Amplats, a new CEO being appointed. But you make money out of bad news, not necessarily good news, when share prices react negatively in the short term that creates opportunity for us as value managers to look towards the long term and to accumulate, a decent shareholding in a company that we believe will unlock value for our investors over time.
Claude, we just wanted to get to that, the question now around Anglo American. Obviously, a lot of their current problems have been caused by the capital allocation decisions that the leadership of the company have taken, specifically some big capital projects in Brazil, the Minas Rios project, and also the decision at a very high level in the market to buy back the company's own shares. Do you think that under the leadership of Mark Cutifani now they'll make better decisions around the way they spend their money?
In terms of capital allocation, let's add that.
Yeah. No, we are absolutely convinced that there will be a better job in terms of capital allocation. We know Mark Cutifani through, over the last number of years, obviously his role within Anglo Gold. And, he's someone that is very focused on shareholder value creation. He's very focused on allocating capital on the basis of generating returns or decent returns for shareholders over time. And unfortunately, the history of Anglo has been that they have bought back shares at the top of the cycle. They had allocated excessive amounts of capital to projects with a fair amount of risk. But going forward, we think this is a very positive change from a management point of view. And the one thing we do know, if you have a decent company with decent assets, the one thing that you can change is management. It's very difficult to change an asset base. We think they've got a fairly reasonable asset base, certainly not the best in the sector. But with a change in management, we think the actions that Mark Cutifani will take, over the next 2, 3, 5 years plus, will certainly be a lot more positive, and we think they'll be a lot more frugal in terms of capital allocation going forward.
Claude, just an interesting note in the resource front. Generally, as a value manager, isn't it quite difficult for you to see these stocks as value plays given their link to external factors? So we're talking exchange rates, we're talking about volatility here of the underlying metals that they're exposed to. Traditionally, isn't this a tough one for you to put into your stable?
Yes, it is. I mean, many of the factors that you mentioned now are clearly very difficult to predict. Trying to forecast commodity prices and exchange rates and so on is fraught with an enormous amount of risk. Having said that, when you invest in this space, and that is how we've always done that, we need to build a sufficient margin of safety. So, the margin of safety that you'll be looking at when you make a capital allocation decision to the likes of Anglo's will vary quite substantially relative to, let's say, a company like an SAB Miller, where the cash flows are a lot more sort of predictable and sustainable. So, just on that note, when we allocate capital to the likes of an Anglo American, the types of expectations that we have for long-term commodity prices are, in real terms, very low long-term compared to where they are currently, and certainly a lot lower than where they were 3, 4, 5 years ago. So your approach to investing in these types of stocks needs to be on the basis of being very conservative with your long-term assumptions, and ensuring that you're allocating capital where the valuation is very much in your favor. And in this case, let's say if we look at the price to book of an Anglo American, the PE multiple through the cycle on very conservative long-term commodity prices, these are levels that we feel a lot more comfortable with in terms of allocating capital to a stock like that.
Claude, I just wanted to bring an interesting angle in here. I mean, this is, when you look at capital allocation, in many circumstances, what we're saying is we want the executives of these corporations to make capital allocation decisions like value managers like yourself. And as much exposure as you guys get to the executives, I haven't yet seen an executive team that's asked a value manager to come and help them with acquisitions. Do you think that time has dawned, in particular with reference to Anglo American?
Yeah, look, I think it's fair to say that the approach that they've taken historically in terms of capital allocation, and we've seen that, we have all the historical facts, has been relatively poor, but not all the decisions have clearly been negative. So, one's got to look at it in the context of the overall portfolio. They've got good, reasonable quality copper assets. They've got, pretty good assets within the iron ore stable. Kumba Iron Ore is one of the lowest cost producers, as you know, in the iron ore industry. It's a very good asset. Unfortunately, that part of the portfolio we believe is a little bit is overvalued. That's one segment that's overvalued within the overall portfolio. But if you look at the other assets, clearly Amplats, there's been a lot of change that has been necessary within the platinum sector. They're taking steps now to reduce the average cost of production from the Amplats point of view, and that's probably a decision that should have been made a number of years ago. Unfortunately, it's taken change in management and a lot of shareholder value destruction in the short term for them to start taking those very decisive decisions. But again, reiterating, that's behind us now. As investors, we've got to look at what is the potential opportunity going forward. And as I said, I think the entry levels now, to expose yourself to the likes of an Anglo American and to a certain extent a Billiton, relative to other parts of the market, I think this is a fairly reasonable entry point.